Okay, so today we're recapping reporting cash flows, but today we're going to be discussing about it in more of a managerial context than we have previously in your financial course. So in financial accounting, we talk about cash flows and how to prepare them from a financial accounting standpoint, but today we're going to go an overview again of what cash flows are, how they're prepared, and then how we'd use them from a managerial accounting standpoint. Goal here is to distinguish the difference between operating, investing, and financing activities. This is hammered, like this piece is hammered down in all of your accounting courses and business courses. You need to know this if you're going into business. And so you should have covered this in financial accounting. You're covering it now, and it's just going to continue to get more and more advanced as you go into intermediate accounting. If you go into finance, if you go into advanced accounting, you continue to learn more and more advanced transactions and how to prepare financial statements, including the statement of cash flows. And that's what I provided. I provided a series of lectures on my YouTube channel related to just all of the different flavors of the statement of cash flows that you can watch. Analyzing the statement of cash flows and applying the cash flow on total assets ratio. So this is related to financial analytics. And then we're going to discuss how we prepare it, how we compute it with the indirect method, and how to determine cash flows to differentiate them from investing and financing activities. And then the plan is that I can go over how you can use a spreadsheet to do this. But since we have the election coming up today, I'm going to let that just be for students. It's optional for students who want to stick around. It won't be on your final. And then the compute cash flows from operating using the direct method. We'll go over this briefly. Most companies don't use the direct method, but I just want you to be aware of how it's actually calculated. So statement of cash flows is one of the easiest concepts, I believe, in financial accounting, but one of the most difficult statements to calculate, because we do financial accounting on an accrual basis, right? So we do, what's an accrual basis? Just to go over, since we've been in the managerial accounting world, accrual basis means that we recognize revenue when we satisfy performance obligations, or when revenue is earned or the income's earned, and then we match expenses to the periods where they create revenue. And since we create all of our income statement, balance sheet, et cetera, that way, then we have to reconcile it back to how these are actually represented in cash flow. So what if we were to do this on a cash basis? And how are we to split it out? What's our cash from operating activities? Operating activities being our short-term operating activities. So accounts receivable, accounts liability, any of our short-term assets and liabilities. What are our investing activities? And those are our long-term assets. And what are our financing activities, which are generally our long-term liabilities? And how do we bucket those off? And it can get complex, because we ask questions like, well, if we buy investments, is that financing or investing? If we get a loan, is that financing or investing? Or what if we use get a loan to buy an investment? How is that represented? And so it gets relatively complex, because we have to not only determine how it's classified on the statement of cash flow, but then we also have to adjust the income statement for it and tie it back. And so always when we're in this, I want us to remember, what is the purpose of the statement of cash flows? The real purpose of the statement of cash flows is to understand, how did we receive our cash? Why do income and cash flow differ? What explains the cash balance? And where does a company spend its cash? So how does a company receive its cash? We want to know. Let's say we're looking at a Tesla, right? Tesla for a long time had a huge operating loss. And so we should ask, as savvy investors, as business students, we should ask, well, then how the heck are they operating? How are you able to continue running as a business? Where are you getting your cash from if you have a loss? And looking at the statement of cash flows, we can decide, are they getting it from new investors, from financing activities, from issuing new stock, from issuing debt? Are they getting it through selling investments, through investment activities? Or are they getting it through their operations? And we can see how it reconciles. Because in theory, right, if we have a company that's operating at a loss for a long time, it shouldn't be able to exist unless we have some kind of cash flow, cash injection. It also helps us understand that sometimes we'll see a company that has a positive income, but then has negative cash flow. That's an important metric, where because of the accrual method, we might earn money, we might earn our revenue, before we receive the cash. And that's important from an investment standpoint. Our light bulb should go off and say, is this cash collectible? Should I be concerned about this financial statement I'm reading if there's a lot of income but a negative cash flow from operating activities? Right? That's why does income and cash flow differ? What explains the change in cash balance? So if cash went up, why did cash go up? Is it because our operations are just killing it? We're having a great time. Everybody loves our product, or is it because we issued a lot of debt? Right? That's important to assess when we're making investment decisions. Finally, where does a company spend its cash? If I'm going to invest in a company, I want to invest in a company that's investing in its people, it's investing in its research and development, it's buying new products, it's maybe buying more companies, mergers and acquisitions. I don't want to invest in a company that seems like all it's doing is paying off debt. All it's doing, it's not investing in its company. Or all it's doing is staying afloat, or all it's doing is investing in its ongoing maintenance of operations. I tend to want to avoid those because I don't see the growth, unless it's some very traditional stock that I think will do very well. So all of the statement of cash flows really gives us a wealth of information and is highly used and is one of the more difficult statements to develop. So as you develop expertise, as you move forward in your career, becoming an expert in statement of cash flows can help you become really valuable in the marketplace. So importance of cash flows. So cash flows help users decide if the company has cash to pay its debts. We're going to see how much cash you have. Can you afford to pay your debts? We can evaluate if the company has enough cash to pursue unexpected opportunities. So a lot of people might ask, hey, why does some of these huge companies have large amounts of capital and large amounts of cash? They're holding on to it to take advantage of opportunities. Maybe a company comes for sale. Maybe they can explore a new marketplace. It helps managers plan day-to-day operations. If they know how much cash they have, the CFO figures out how much cash they have and they allocate the budget to each department, your accounting department, your finance, your sales. And then each of those managers will then allocate budget to figure out how many people they can hire. We went all the way back to our master budgeting, right? That's where it comes in. Our master budget, we build a statement of cash flows, a pro forma statement of cash flows from that master budget. We need that to budget. And then we can make our long-term investment decisions we talked about in budgeting as well. We can decide, can we buy that new office? Can we buy that new manufacturing plant? If we can't, how can we finance it? So what are cash flows? So when we're talking about statement of cash flows, we're actually talking about cash equivalents. So you'll see in financial statements, cash and cash equivalents. Cash is cash, right? Cash is dollars, USD, GBP, any of those metrics, the pound, that's money that you can trade for goods instantly. That's cash. But there's also this idea of cash equivalents. So what are cash equivalents? We're saying that anything that's highly liquid. We've talked about liquidity before, but there's liquidity and solvency, right? Liquidity is the ability to convert assets into cash quickly. Solvency is the ability to convert the ability for a business to convert their assets into cash in the long term, over a year. So we're normally talking about highly liquid investments. Cash equivalents, we're talking about less than 3 months. And so ideas of a cash equivalent would be very short-term bonds, like 3 months or less. Talking about money market funds, talking about very, very short-term loans, less than 3 months. Any of those things will actually bucket into cash because they say, hey, we're going to convert this so soon, there's really no risk. The idea here is it's readily convertible into cash and it's sufficiently close to the maturity date. So this can be complex when you're reading a financial statement, because if you have a 10-year bond that's at the end of the financial year you're assessing is going to be due in 1 month, right? So it's a 10-year bond from 9 years and 11 months ago. We might say, well, that's actually a cash equivalent because we're going to redeem that soon, right? So we change classification on an ongoing basis. First, it would be a long-term bond, then it might be a short-term bond. Then we might say, hey, this is going to pretty much cash because we're going to redeem it next month.